Hi, my name is Pat O'Connor. I'm the broker owner of the Veritas Real Estate Group. We're located in Coral Springs, Florida, and today I want to talk about the tax benefits of owning real estate. Previous videos have covered the tax benefits of selling both your own residence as well as investment properties. So I'm just going to summarize those now, and there will be links at the end of this video to each of those two other videos. All right, so when you sell your primary residence, and if you have lived in the property for 2 out of the past 5 years, and you are filing singly, you can claim $250,000 as tax-free capital gains money. So you bought your house for $150,000. After all the closing costs, you sold it for $300,000. You're filing either singly or married. In this case, you can walk away from the closing table with $150,000 in tax-free money. You can do this every 2 years. Only criteria, and you can check the IRS code in the description in the previous video. A few exceptions, but you live in it for 2 years, sell it, have those capital gains free. So again, you have to live in it for 2 years. All right, so investment property, you don't get that tax-free money, but there is something called a 1031 exchange, like-kind exchange. Any profit that you make on the sale of investment property, you can roll over into the purchase of another real estate property. So if it's vacant land, you can roll it over to commercial property or residential 1 to 4 unit properties, and you can delay paying the capital gains tax indefinitely. If you keep it up until you die, then it's your heirs' problems. So if who's ever, the executor of the estate, they can worry about it. So that's called the 1031 like-kind exchange, and it's for investments. And it applies to all kinds of investments, like stocks and artwork and that kind of stuff. But it's like-kind, real estate for real estate. So check out that video if you want to learn how to delay paying capital gains tax. All right, so what are your annual benefits when you go to file your tax returns? And you may have to itemize to get some of these benefits. When you when you own your own home or when you own investment property. So when you own your own home, property tax. All right, and that can be, a big thing depending on where you live and if property taxes are increasing every year. So that's a great benefit for owning your own home. You pay the property tax, but it's a tax deduction, and it may get you into a lower tax bracket, right? All of these deductions that I'm going to talk about now may actually be enough to get you into a lower tax bracket so that your overall taxes are going to be lower every year. Okay, so property tax, mortgage interest on your residential primary home, you can deduct the mortgage interest on up to $750,000 of debt. So you may need a CPA if your home is worth more than that to figure out how much of that you can actually deduct. Okay, so that's primary residence. There's a cap that went in a couple of years ago, and it's now $750,000 for your primary residence. You can deduct that. Home office. If you work from home, you can't do this if you're employed, but you're a freelancer, you work from home, You have a room dedicated to a home office. There's a complicated figure to determine how much you can deduct, or there's a simple $5 per square foot up to 300 square feet max for the room. And you can take those deductions. So just make sure, it's got working space in it, and just in case any questions ever come up, and that is in fact your office. All right. So mortgage points for the year of purchase. Sometimes you pay points to lower the interest rate. Like 1 point is a certain percentage of the loan amount. So if you pay these, those may in fact be deductible. They won't be deductible every year. This will be a one-time deduction that you may be entitled to. So talk to your CPA. The other one is if you take out a home equity line of credit, also called a HELOC, HELOC. Now you can use that line of credit for anything, but if you in fact use it for home improvements and keep all your receipts, keep all your records, the interest on that HELOC for home improvements is deductible. Okay, so primary residence, we have property tax, we have mortgage interest, we have home office, we have mortgage points for purchase, and we have the interest on a HELOC if it's used for home improvements. All right, so investment property. What can you deduct for investment properties? More. Okay. Uncle Sam likes to reward people for owning property. This is one reason why they say rich people don't pay much in tax. And it's because they take advantage of all the legal tax shelters that the IRS provides for people. So the first one, all the types of liability insurance that you may have on your investment property. So it's hazard insurance, it's liability. A lot of times people have liabilities in case their tenants may fall and, break a leg, or, workers coming on the property, they may get injured, or the tenant's dog may bite somebody. They're not going to sue the tenant, they're going to sue the landlord. Okay, so liability insurance. Sometimes you can, there may be different types of insurance. So any kinds of insurance will be covered. The mortgage interest, and there's no limit. Like for your primary residence, it was limited to $750,000. With your investment properties, there is no limit. So the entire mortgage interest you can deduct. Property management fees, particularly if you are an absentee landlord. You live in a different city, you live in a different state. You are paying someone or some company to manage the property for you. That is deductible. Maintenance repairs, those are deductible on an annual basis. You need to get a plumber in, you need, a new refrigerator. You need those kind of things to keep your property in working order. Major things like a new roof, they would deduct over the course of years. It would be a capital expense. Improvements that may last for a year, more than a year. Talk to your CPA. Those may come under depreciation category. And speaking of depreciation, this is a great asset, great advantage of owning investment properties. You can take the value of your home, if it was a fair market purchase, deduct the value of the land, and that amount divided by 27.5 years is the amount that you can deduct on a residential property every year for 27.5 years on your investment property. This is not commercial. This is residential, 1 to 4 units. Okay, 27.5 years. For commercial properties, it is 39 years. So you take the value of the property, what you paid for it, minus the value of the land, divide that by 39 years, and that is the amount that you can deduct from your tax return every year for 39 years. And you might say, okay, Pat, how do I know the value of the land? Here, at least here in South Florida, if you go to the property appraiser's website, and in Broward County, it's BCPA, Broward County Property Appraiser.org. And I assume wherever you are, it is something similar. It's on a county basis, okay? And you put in your address, you see your record there for the address, and they will have 2 columns. And one is the price that you paid for it, and one is the value of the land, okay, of that price. And I know when I sold investment properties, my CPA told me, get it, or you can get a brand new appraisal that appraises the land value. If you think that the tax record, may not be correct, you could always get your own, I am assuming. Just keep records, all right? But it's quick and dirty on the property appraiser's value. Here's what you paid for the property, and here's what portion of it was for the land. Subtract the 2, divide by 27.5 or 39 years, and that is your deductible for, that period of time. So that's great, and that you don't have on your primary residence. You can't take depreciation on that. So the last thing here is advertising. If you're going to have tenants, you're going to have to advertise that there is vacant space. So this may include, paying a commission to a real estate agent, making up signs, putting it in magazines if it's a commercial property. So all of that would be tax deduction. I am not a CPA. I am not a tax attorney. So make sure that you get professional advice if you need it to fill out your tax return every year. So maybe this video's convinced people that maybe it's a good idea to go buy a duplex. Start with something small. Or buy, a 1-unit condo and rent it out. Whatever it is, you can take advantage to lower, perhaps put you into a different income tax bracket. All right, so the 2 links will be on the screen now, and you can go see the tax benefits when you sell property. 2 videos should be there that you can click on. Okay, if you like this and think you learned something, please subscribe. It helps me, it helps you. You won't miss any of the videos. So that's it, and I will see you next week.